Okay, we're rolling. It's it's the second week of April 2025. I can't breathe. I can't see.
It's the Nashville Basin.
This sucks.
We got
Yep.
Oh,
storms on the way. I mean, you know, what what other kind of perils are?
Right?
Perils is right. I thought, it's gonna rain. That'll help my pollen. That'll help these issues. It'll kind of it stirs it all up and it makes it worse.
And
So
more things bloom.
yeah, it also
And
might
then
be that
mold grows.
I cut all my hair off and that was grabbing all the pollen and keeping it away from me.
That's
But
it.
I still can't transition out of the long sleeve shirts into short sleeve. Because
right.
so,
Well, I've made the hair transition, so you can make the shirt transition coming up. Definitely would be. I went outside today. It was like 82 this morning, just as Jennifer says. Yeah. What was your Jennifer? What are you saying? It's what outside?
It's juicy is one of the words I refer
Juicy.
to. Juicy and still, but it's also like right now it's windy, and you know that's like it's so muggy. It's as muggy as it is in July, August, but there's not that heat, so it's very. I mean, it's like walking into a steam room, kind of. And then
You
there's
know.
this stillness, and then there's big wind, and we are going to get hammered tonight.
Yeah. You can
We're
always
recording
tell.
this on the 2nd, just FYI. You're going to see it next week, but it's going to be, I think it's going to be worse than Sunday.
Now, Mark, you know what we call August up here in Tennessee, right?
no, what y'all call it?
Hell's doorstep.
Yeah.
Okay.
So we get a couple fake autumns in the spring, a day or two, and then just anyway.
Yeah.
But yeah, it's gonna
Mark's used to
turn.
living in the devil's living room.
Yep.
Yeah, I mean, I am a man of faith, but I mean, look, when it's 105 out and 60% humidity and getting out of the shower just means you're just going to start sweating again. You should get back in and then go back out.
I,
You know,
I had
Mark,
basic
did I tell you my Texas joke? Did I tell you my joke about the two Texas guys?
No.
These two Texas guys passed, and they went down to hell, and the devil comes in, and they're like just talking and having a good time, and he's like, you're not supposed to like it in here. He's like, nah, this is like Texas in the winter. We're good. He's like, I'm going to turn up that heat. So he turns the heat up, and he comes back, and they're like barbecuing and drinking a beer, and he's like, what are you doing? You're not supposed to like this. He's like, nah, this is like Texas in the summer. We're all good. He's like, I'm going to show them. And he turns it all the way down. It's cold. And he comes back, and they're high-fiving and cheersing and doing shots. And he's like, what is with you two? They're like, dude, hell froze over. The Cowboys must have been in the Super Bowl.
You're digging deep.
Hey,
shots
as a Browns fan, this is pot.
well,
Hello, pot. This is kettle. I'm black too.
the fact that you just revealed that you're a Browns fan, I need not say anything more.
No, absolutely. I got no stones to throw. But when you guys were talking about heat, that reminded me of that one.
Have you seen the new stadium plans, Jennifer,
For here?
for Browns?
No.
They want a new
I hope
stadium.
they get some plans for some freaking players and some actual.
Hey, you got to spend the money somewhere.
Well,
All
I mean,
right.
when they
Well,
opened
today-
Jacobs Field, they did great. I mean, we had some serious good times with Manny Ramirez and Albert Bell and Jose Canseco and all that group.
94, 95?
Yeah.
Showing our age. Mark was he was in you're our age.
Yeah,
I was
I
gonna
may
tease you.
even be older.
All right, well, today, if I can talk through this mess, we're going to talk about loan programs that are available from a mortgage perspective and maybe some stories related to that. Jennifer and I did an open house this past weekend for one of her properties out where she likes to play out in the country.
Yep.
What town was that in?
The address is 211 Jack Taylor in Unionville, and it is 2,300 plus square foot on over 2 acres with a semi-in-ground pool, hot tub. And it's a great location because it's out in the country and there's fields around it. So you're not like up against neighbors. There's neighbors on one side, but they're all 1 acre lots. So you're spread out. And it's like 30 minutes to Murfreesboro, where there's Costco and Sam's and all kinds of restaurants. 10 minutes to a fantastic Italian restaurant called Sorrel's. A local ice creamery on a dairy farm is really close. Chapel Hill has a grocery store called Brooks that's amazing, and that's maybe 15 minutes from there. Same with Henry Horton. And then maybe 25 minutes down to Shelbyville, which is like the closest Lowe's or big hardware store. So it's in the country, but it's not absolutely remote.
So it's interesting. I took the back roads, even though this was located on a back road. I took the back roads on the way home, and I ended up over towards Rockville, and I went into Eagleville, and it took me straight. It's Arno, Alisona, or something like that.
Yeah.
And for the next 30 minutes, Mark, I drove past McMansion after McMansion after in the middle of nowhere, after Bill Gates home, after Steve Jobs home, after Donald Trump home, after every property, both sides, for 25 miles at least. And I took a little, I don't know, I meant to call you, Jennifer. I didn't know what to think of it. It is tremendous in Middle Tennessee, the amount of wealth that's moved in. And we can talk about this in our podcast. So would that wealth had arrived with rates at 6.5% and 7%? I think not. I think a lot of these houses were built and started the financing probably in 2021, 2022. They're all done. And I'm just flabbergasted. I really don't even know how to process. I don't know. Am I jealous? Why didn't I get the loans? Did they pay cash? Who are these people? And it's not 2 or 3 houses, guys. I'm hundreds and hundreds of homes as I drove.
Yeah.
So
there's a lot of large acreage mansions over there. Like my son William works for a builder, Urban Development Group, and they've got a big house. They call it the Arno House when he has to go work on that site, and it's on, I want to say 5 to 7 acres, and it's got a guest house, and it's got an infinity pool, and a lot of really nice things. There's also a community over here there, and I'm completely blanking on it right now. But it's got, yes, it's got a golf course. It's got, golf cart community, so to speak. But they have like a masseuse on staff at the clubhouse. Like it's that kind of living. Which, if you've got your budget straight with Mark, go for it.
Absolutely. That one's been there about 20 years now.
No reason why you can't build wealth.
Yep.
Well, I don't know if it's wealth or not. I mean, it looks like wealth. I think that'll all come out. Well, let's talk about something for a second. So I talked about this at BNI yesterday, Jennifer. So big news event over the weekend. Several of you have seen it. It's a graphic that shows a spike in foreclosures that basically has gone through the roof. It's an alarming stat if you don't look at it in context. So I have had the opportunity to look at it in context. Are either one of you familiar with it?
No.
No.
My dog had surgery this week, so
Yeah.
I've kind of been under a rock.
I likened it to kind of what we were talking about before we started recording, which was last Sunday night. I think a lot of media, I think a lot of the things that, definitely not the three of us, a lot of things that are put out for consumption, a lot of it's sizzle. What's happening? Storms. So Mark's like, I didn't even know there were storms last Sunday night. Well, Mark, let me tell you, I and Jennifer may know this too, but Jennifer and I were introduced to a new vernacular, and Jennifer studied the English language. And there's I like to quote George Orwell's The Decline of the English Civilization, which is a book about the decline of our language, right, Jennifer? If you try to read a book from the 1800s or early 1900s, it's almost impossible because we don't have those words anymore, or definitely the conjugation. Well, do you remember what that word was that we were introduced to, Jennifer, that was the big hubbub on Sunday night? It was a storm-warned tornado.
Storm emergency. Oh, yeah.
A storm-warned. Never heard that. Now, Mark, do you have that in Texas, storm-warned?
Storm-warned, W-A-R-N?
ED.
Oh, well,
Me
I
either.
don't think
It's a
so.
new
I don't think so.
word.
What we do have is like kind of going along with that. Like the National Weather Service will issue like a PDS from particularly dangerous storm,
Yeah.
particularly destructive storm, and they have ratings. But storm warned.
It's a new thing that just arrived last week, and they're like, "This is we're tracking this storm warned. We were storm warned about this yesterday." And they're like, there could be rotation, there could be a debris field. If you're in Cool Springs, so I get that their job is to save us, but it's the sizzle. And I'm scared to death of storms, so I was a total wreck that night. Well, we get up Monday morning, and here's the news from not NAR, but someone else's report. There's foreclosures there. And it's the line, I don't have the graphic, but it goes straight up. And it's true, but it applies to one type of properties. Jennifer, where do you think it is?
Is it residential or is it commercial?
Is residential multi-unit.
Yeah, which is on the edge there. Yeah.
And so what that means for those of you watching that means there's a very high foreclosure rate. It's not just a little blip. It is a straight line that starts at the first of the year. And it says that people are defaulting on properties that they own that are 2 units, 3 units, or 4 units, and that they live in one of them. So this is an SFR, owner-occupied, multi-unit property. So a lot of these probably came to be in 2020 and 2021 when Mark's nodding his hand, when everyone sat up in the morning and said, I'm going to be a
landlord,
a real estate investor landlord, and I'm going to take on these 3 houses. And they're probably enjoying their 2.5% interest rate. But what the rest of the country hasn't been enjoying is that their money isn't going as far. So now that landlord has to deal with those other unit members paying or slow paying or not paying. And that's where by the way, that's where it always starts. We have a little bit of a crash. I'm not saying there's a crash coming. I'm saying that is a subsegment that probably was people got themselves into trouble on it. And I think that the rest of the economy of what we know it, the 3 of us on this call really know it to be, probably is affecting those people. But they didn't sell it as that. That was in the small 7-point type in the very bottom left in italics that you could barely read.
Yeah.
But it was all over. We've all had our lives going on. But saying all that, the mortgage market is just rocking and rolling. There are deals and contracts coming in left and right, all types of inquiry. People are excited. Interest rates are a smidge down, just a tiny little bit.
They're down?
Just a tiny bit, but not really. They're in the mid 6s. But I wanted to talk about some of the loan programs that we'll use today. And in the bottom here it says be in the loan no. So I thought that was a little bit of a fun.
Before you jump into that for a
Sure.
second, for everyone listening, what he just said was really, really important. I want to hone in on what he just said. Applications for mortgages are increasingly up and going up and off the chart, and only a small little decline in the interest rate. So this whole idea that I can't buy a house because the interest rates are too high is absolutely not what he just laid out. If you want to buy a house, it's because you're ready to buy a house, and none of that will stop. It appears to be stopping people who have likely gone through the process of preparing themselves for buying a house. In other words, what is the interest rate, Lance?
About 6.5 or better.
So if mortgage applications are going through and increasing, for all of you that are listening out there that think, I'm not going to buy because the interest rate is too high, what you just laid out was completely counterintuitive to your thoughts.
Yep.
It's all about preparation.
And evidently a lot of people are ready.
And a lot of people are ready because they've tapped their finances. They're in control of their finances. interest rate's not going to stop me from buying a house. And they're leaning in.
Yep.
Well, I think a lot of the people have been waiting and waiting and waiting. There's been a lot of pain pressure points for people wanting to move. And the people who were wise got serious about getting ready. Like, it's one thing if you're in a small, I'm just going to say, 1250 square foot home, and it's you and your spouse and you have a child. Until that child's probably 2, 3, they're not taking up a lot of the space in the house.
Mm-hmm.
But we're such a consumerism world that when they hit 2 or 3, they've got toy explosion everywhere, because you're not allowed to go to the store without picking up something for your child to come home with, or they have an outright tantrum in the store,
Well, you love them, don't you?
Yeah. So if you get, if you're able to kind of make do, but now you're tired of making do, or maybe you've made do and they are now 4, but now you've got another on the way. You didn't get it. You got beat out of buying a bigger house or a different house when 20 and 21 were going on. You had the child. Now you're having a second, and now you're like, okay, we can't squeeze this anymore. Or you have elderly parents that they were going up and downstairs or had mobility issues, and you've managed it and you managed it and you managed it. Okay, we've just got to do. There's a lot of people who are just like, we've just got to bite the bullet, and hopefully those were the ones that were improving themselves for when that we can't hold out any more longer, which is actually very comical for a history major here, which y'all know because I say it enough, that you used to have a one-room cabin, and if you were lucky, the kids had a bedroom in the loft.
Yep.
We
just all slept in the same bed, like my mom.
Yeah.
I had like 9 kids in a bed together.
Yeah, that John Denver song, Grandma's Feather Bed.
Mm-hmm.
All the cousins and the coon dog.
It's true.
Yeah.
We're just going to put up some bunk beds there for you.
Yeah, if you're lucky. Otherwise, make a pallet on the floor.
Well, let's talk about.
Tell us about the loans, and
let's talk about what loans would be good for that.
Yeah, well, no, because sometimes I'm like, hey, Lance, we've got this person. They're ready to buy a house. And one of the things I completely trust about you is tell them what's best for their situation, their scenario. And occasionally you'll have said like it's an FHA or it's a VA or it's a USDA. And then I'll be like, oh, okay. Anyway, they can go conventional because we found a house they love that can't go under those. And so sometimes you're like, yeah, they could, but it's really not in their interest. So tell me how you figure out and help them analyze the best loan for them in different scenarios.
Well, I have to give a disclaimer. So up at the top right, you see the logo of I Love My Tennessee Home for Jennifer. I have to give a disclaimer. I've worked with her for almost 10 years now. And although Jennifer has given me kudos and tell me that she trusts me, and she does, and I trust her, there have been conversations where I'm like, I'm not sure that's going to go XYZ loan. And she goes, oh, wait a second. Yes, it will. It will. I'm telling you right now. And, I've been in the business for 25 years. And really this year, we've had a couple transactions together that I think neither one of us thought would go one direction or the other. And and they did. It's a new climate. Her years of experience and the number of units that she's worked with and my years of experience, you put those things together, and Mark's expertise too, we're a pretty formidable foe, and I'd put anybody up against us. But let's break up into that. I'm going to try to present. Let's see if I can do this. I always have trouble doing my presentation problem. So let's see here. I'm going to go to share.
Screen. Yep. And then you have to go to not Windows, but computer.
Image file or share screen?
Yeah, under share screen, and then it's the one on the far right.
Entire screen?
No, like there should be like okay, something's happening. There you go. Yeah. Oh, if you want it to be bigger, you have to go to slideshow first. There
How's
you go.
That look?
Yep, that's good.
You can see the whole thing now?
Yep.
Yeah.
And can you see you guys along the sides?
Yeah,
Yep.
not that people want to see us today, but
Perfect.
yes.
All right. So the first loan I was going to talk about a little bit is the FHA home loan. So that's the Federal Housing Administration. Those are home loans that are provided by the Federal Housing Administration and they make it easier for people to buy a home. So what are some of the product highlights of that? Number one, a low down payment option. 3.5% is what is required to do a FHA loan. 3.5%. Now you'll hear some people talk about, oh, I was told about a 100% FHA loan. That's a play on words. It is an FHA loan, but it is partnered with perhaps a bond program in the state or a local program that allows a small second mortgage to be put together with the FHA loan to make it seem like it is 100% financing. We actually do a lot of those in Middle Tennessee, mainly through what's called the Tennessee Housing and Development Agency, THDA. Quick highlight about that, they help people attain home ownership. They have income limits. For 2 people in a household, the limit is around $103,000, and the purchase limit, the most house you can buy, is $400,000 in the Middle Tennessee area right now. So you can get a lot done doing that. Interest rates are a little problematic, but they're getting better. So when interest rates get better, that program really picks up steam. So another product highlight of FHA would be flexible income and credit requirements. So credit can go down to 580, a 580 credit score, and they will look at income many different ways. They're also flexible on how bankruptcies are treated. Bankruptcies, there's a Chapter 7 and a Chapter 13 bankruptcy. FHA is the most lenient about those. In fact, you can be in a Chapter 13 bankruptcy. Get this, Mark. You can actually be in a Chapter 13 bankruptcy and purchase a home, so long as you've been making payments on time to the Chapter 13, to the, I have a blank for a second, the people that are in charge of the 13. What are the creditors? And you have to get permission from the bankruptcy court to do it. But we've done several of them in the past. You won't see that with conforming. We'll talk about that in a second. A moment ago, we were talking about multi-unit homes. So the availability of a loan for a 1 to 4 unit property or condo. Fun fact about that is you have to live in one of them. And that is something that is a very popular thought process. It's very popular to think about. But Jennifer, would you mind telling us why it doesn't always come to fruition, a 1 to 4 unit purchase for a customer?
There's these things called investors running around. And so if you happen to see a multi-unit, even a duplex, available in your price point, an investor is probably going to offer cash and quick close and no appraisal and no inspection. So it's very hard to compete with what I call sometimes the big boys, even though they're not like huge conglomerations. Lance, I had a question for you really quick. With the going down to 580, there may be some stipulations with different things. Like if you have a lesser credit score, or you have something else, is that when they're going to maybe ask for reserves or something like that? Because
yes, they're called compensating factors.
Okay.
So,
and you don't have to go into it. I just was a little.
Compensating factors can overlook certain things, can be explained. I mean, when I talk about leniency, I mean, you could have someone that didn't have a job for XYZ period of time. Where with conforming, they'd be like, oh, sorry, there's a job break. FHA will allow you to do an LOX, a letter of explanation about what exactly happened. Is it sensible? And it could be admitted as a compensating factor to why we should do the loan.
And so, like, is it likely to happen again? Like, I took off 4 months to help my aging parent who has now passed away.
No, absolutely. We just, we're doing one today that we're working on where the person got injured on the job and had workman's comp for 4 months. There's a big break and you got to explain it. And that's an allowable explanation.
Okay.
I like how you answered when I said, Jennifer, what do you think of that? I like the way that you put it in financial terms. And the word I wanted to use was scarcity. And we're talking about those 1 to 4 units. They're scarce. They're very hard to find. Many people know, investors particularly, the value of a multi-unit property. I believe there's one on this call with us, is there not?
Mm-hmm. I think he has one.
Yes.
Mark understands the value as a financial advisor and planner. He owns a multi-unit property. Mm-hmm. We were talking earlier in the call, I think, about some of that. There's some defaults going on in that because when rates were 2% and 3%, people were able to take that on. And we'll see how it all comes out in the wash. But FHA, they allow things like it's a Federal Housing Administration. There's some fees that come with doing an FHA loan. FHA loans have mortgage insurance forever. They didn't used to until the mid 2000s. It used to be when your house got to 78% loan to value, the mortgage insurance would come off, but it does not anymore. It's for life on an FHA loan until you refinance into another product. And specifically with FHA loans, you have what's called upfront mortgage insurance. It's a simple calculation. It's for every $100,000, it's 1.75% that's financed into the home. So if you're borrowing a $300,000, if you're doing a $300,000 purchase, and you put down 3.5%, your loan amount would be $289,500, but you would take that times 1.0175, and they would finance that in, making your loan amount $294,000. So about $8,000 is wrapped into that, and that's how the federal government can help make these loans available to people. You guys want to know another fun fact about?
Well, I want to know a definition of what is it like. Can you it's PMI we're talking about, right?
Yes.
So can you say PMI is like, what's it do? Why do I even have to have it?
Mortgage insurance guarantees the investor, which is the federal government, the ability to move that house if they ever had to foreclose on it. So let's say that 5 years into it, the borrower quits making payments. They now have to go out and survey that home. They may have to go out and close it up. Think about 2008. We had all these foreclosures.
I sold some HUDs.
Got it. They had to go out and assess exactly the condition of the house. They had to do repairs, and that funding is set aside for those. There's a calculation that goes towards that. And,
okay, so it's insuring the government, who is the lender, on the off chance that they have to go out and winterize the home, or maybe the home loan is like $350, but they only get $300, so it insures against that loss as well.
Correct. What they might have to sell it for, as well as the repairs.
All right, makes sense.
So I started to throw out a fun fact, and I think I've talked about this before on our call. And it's, who do you think is a better? It's a loaded question now. What's a better credit risk? An 800 borrower putting down 50%, or a 600 borrower putting down 3.5%?
What's a better risk?
Yep.
I'm going to go with the 800.
Yeah.
Okay. That's what common logic says, but it's not the fact. Fannie, FHA has found that their low to moderate income borrowers perform better than high income and lower LTV loans.
Interesting.
People that have to work hard. So remember what we were talking about a few minutes ago? Like, people have gotten ready. It's the grasshopper and the ant. They have set the money aside. They have paid the piper, and now they're ready to attain home ownership. Would you agree, Mark, have felt the hurt the last 18 months?
Yeah, and this is really important, because that statistic would point to the mindset of what a person where a person wants to go. I mean, if the person that's making a large sum of money, no big deal. I can pay this off whenever. That mindset versus, I'm going to work hard, and working hard to get to what I want to get to and buy a home, and that growth mindset, and what am I willing to give up in order to grow? Clearly, and probably the majority, I obviously don't know, but I would bet that mindset is the driving force behind that statistic.
Mm-hmm.
It's amazing. They perform so much better. And Jennifer and I have danced around this conversation before, and I don't typically have this conversation with realtors, but I can have it with Jennifer. We have a lot of people that move to Middle Tennessee from California, and they're coming in here and they're paying cash for homes. My question is why? Why would you take this is a good Brady Bunch argument with the guy up here over my shoulder. But Mark might agree or disagree that you don't have to pay for all of it. You probably could leverage some of it. And the fact that house is going to go up and down in value regardless of how much you owe on it. The fact of someone who has so many of these people, I don't know the stats. Jennifer can help with this as well. But you have time and time again, this sounds insane. You've got a 35-year-old couple, have one baby, showing up here from California, buying a $2 million house for cash. They sold their house in California. Well, it was an 800 square foot house. Who bought it? Well, a corporation bought it. And all their eggs are in one basket. I have had a few of those calls where they're like, well, I don't have a job yet. I need to refi. I need to get some of my money back. So if you'd like to talk with that a little bit, Mark, I have always thought and I've danced around it. like if you're a realtor and you had that type of deal, it'd kind of be a good time to talk about, okay, well, what if you put 50% down? And what if you bought an investment unit or two to help diversify? How do you look at that, Mark?
Yeah, quite honestly, I look at it not very far off from what you just described. I want people to have a paid off home, but I want them to do that with intentionality, and throwing a little bit extra towards their mortgage over time. But I don't think so. There's a real important lesson I feel like it needs to be addressed here, and that is, going back to why people might be better prepared at the 600 and a better risk is because they understand a little bit of hurt in order to get to where they're going. When you come rolling in and you just throw around $2 million, you know what? I'm going to pay off an $800,000 house. It's no big deal. It's blah blah blah. You don't have that. Understand? I think you lose the idea of that little bit of hurt of where you got to when you have to make that payment. I'm not suggesting that if you have the money, don't pay off. I'm not suggesting don't pay off the house if you have that. But what I am suggesting is don't forget where you came from and how you got there, because there's a little bit of there's a lot of learning lessons with a little bit of hurt in order to get there. It's your story. We often talk about this. I don't mean to sidebar this at all, Lance, but I often talk about this in my coaching sessions about the quote silver bullet. The silver bullet is, I'm going to sell my house and I'm going to be able to pay off my debt. What did you learn? Have you anyone out there asking yourselves or listening to this? Ask yourselves if this describes you. If you've taken that step, what have you learned? And since you've done that, what have you drifted back into the thing that you used to pay it off? Eventually, you're going to run out of silver bullets, and that's when the pain hurts. That's what you gotta, and that's a valuable lesson.
Well, you're talking about me.
So I got a couple things to share with that too. Lance, sometimes we've got people and they've got a good down payment. Maybe they thought they had to have 20% down. They were saving up for that. We've talked to them. They don't have to have that, but they have more than the 3.5 or more than the 5 that you might need to put down under conventional, but they don't have enough to get rid of PMI. Mm-hmm. And so you and I have talked to them sometimes about, okay, maybe we, and we've said we'll talk about this another time. We do need to about buying out PMI and when you can do it. But sometimes your best play, if you've got maybe 12% to put down, is to put down 5% and take the other 7 that you have left over and look at an amortization table so that you can be paying down towards the principal and paying it off more quickly. What's the best use of your money? Yeah. The other thing is the people who come in and they buy this house cash, they don't have a job yet or what have you. Do they have money for the maintenance on the house? And that leads me into the other thing, like, you're talking about, I need to refi because I don't have any money. Lance, you and I have talked about for a long time, if you are a small business owner and a homeowner, you should have a HELOC in place before you need it.
Yep.
Because if it's a slow time where you don't have income coming in, and this is literally an emergency fund. This is not just willy-nilly stuff. Or maybe you're ready to expand and you've got to get a new truck, something happened to it, and your business is truck dependent, or you have to put that little bit of money in to make that next step up, but you can't get a loan because of where your income has been. If you have that HELOC in place, then you can draw on it and pay it back quickly. But HELOC rates are high, so this is an emergency situation. But if you are a small business owner, having a HELOC is not a bad thing. But those are
actually some special considerations for that there are some special laws in place, Jennifer, for small businesses to use personal property for HELOCs. For example, you don't have a right of rescission on that. You can have instant access to your money to help save your business. There's several things that are allowable, in some cases higher LTV
All right. And so for
because it's
people who don't
preserving
know
the
what
business.
Rider Precision is, when you have a cash out refinance or you have a HELOC where you're getting money from your equity in both of those situations, there's a 3-day wait period. And I believe it started because of some predatory things and from people not really knowing it's a cooling off period. I've done my loan. I have to wait 3 days to have that. And during that 3 days, if I'm wrong, Lynch, you can say to
You're
correct
fine.
me, but you can say during those 3 days, hey, the bad idea, I don't want to do this. Or I was being coerced into it or something, not by the lender, but like a spouse or a family member or a
Right.
business partner, God knows what. Is that the
Um,
nutshell of the
Yeah.
position?
You did it right. You explained it completely right.
Amy?
I need to step away for about 30 seconds and because of my allergy things. But when I come back, actually, I'm going to tell you about it right now, and then I'm going to step away. So Jennifer was talking about, hey, maybe don't put so much money down. Here's an example of that. Let's say that someone was doing a loan and they were like, I don't want to have mortgage insurance. They had a really good credit. I don't want to have mortgage insurance. I've got to put an additional $50,000 down. And the loan amount was $300,000. It was like a $300,000 or $400,000. They're like, I've just got to get to 80% and not have that mortgage insurance. Well, when we look at it, we find out that their mortgage insurance, because of their great credit, low risk type of house they're buying, maybe their mortgage insurance was only going to cost them $65 a month. They're like, I don't want that extra on my payment. But what you can do is take that $50,000 that they're going to put extra towards the house and amortize that, whatever the mortgage rate would be on the loan you're doing. So I did that while Jennifer was talking. So $50,000 at 6.5% for 30 years is a monthly payment of $316. So what she was trying to say is, why would you try to pay $316 of your earning power to save 60? So those are the type of conversations and Mark will have with someone. I'm going to step away for a second, guys, and we'll come back and I'll talk about one more thing about FHA. I'll actually give you a little heads up, Jennifer, and you can talk about that. And that is, with FHA loans, you have the ability for your down payment funds to be from a gift, relative, or employer. I'll be right back. You guys talk on
Okay.
that.
All right. Sounds good.
Yeah,
We'll have him correct anything. So the thing with gift letters, Mark, have you ever had anyone do one of those?
I have had a gift letter from years ago.
Yeah, I mean, it has to be a gift. It can't be like, okay, and everybody has to sign off on it. It's a gift. And I'll tell you the thing that really got people sideways. Okay, so I have 4 kids. And if I'm going to gift one of them money for the down payment, the best process is for me not to write them a check for $10,000 and have them use that for their down payment, or even to wire to their account $10,000 for them to use for their down payment. The best protocol is to wire it straight to the title company on day of close. And the reason is, when you're doing a loan, we've always said it's like a proctology exam. They have to look at seasoning of money in all the accounts. So they have to look at your checking, all the accounts that you're using on the transaction. So if you have 2 checking accounts and 1 savings account that you're using in the transaction, the lender has to get in those and see what's going on. If I gift my child $10,000 for a down payment, which if any of my children are looking, go smoke something because that's not happening. All right, so let's just get this out there, right? But anyway, if I had to give something to one of them, if I wrote them a check or I wired it to their account rather than straight to title, then the lender has to look at my account to make sure that money has been seasoned in there and that I'm not getting it from some way that disqualifies it. And also, if I have it from 2 accounts, then it has to be that. It's like a 60-day look. I was talking about the 60-day look back if you write a check or wire it to the kid for a gift. And a lot of parents are like, hold up, I don't want you in my business. And so now we're like, okay, we'll wire it straight to the title company, and then it's cleaner for everybody.
Yep. And it's not a loophole. It's just how it is. If it
Yeah.
gets wired in straight, you don't have to source it. It's one of the first things we talk about as we try to stop people. Oh, I'm going to get money from my parents. Oh, didn't even give it to you yet, did they?
Yeah.
Oh, no, they're going to do it tonight. No, don't.
Yeah. I'm going to take my mattress money and deposit it. No. I'm going to take my dad's mattress money and deposit it. No.
Happens all the time.
There's another financial coaching lesson in this too, which I don't want this to go talked about with gifting money. if you're being gifted money because of whatever reason to get in the house, is there an agreement behind that gift? Yes, I understand from the legal perspective that it's a gift, okay? But if you're borrowing money from a family member, one of the most important things is have an understanding of what this money is before it is handed out. In other words, one of my people that I look up to in the coaching business, who is very well known, talks about how Thanksgiving is not the same when you owe someone $20,000.
Mm-hmm.
So even though they're gifting you this money, make sure that if this from the legal perspective, have a conversation about what this money is and how is that going to be handled? Is it truly a gift from the person to you? And if so, great. That is an understanding that has already been made. If it's not, then people need to have, before any money is exchanged, a clear understanding of what the repayment program and what is to be repaid back.
And sometimes it's not even the repayment program, Mark. Sometimes it's, I bailed you out of a situation. I repaired something on your house. I gifted you money because I did want my child to have a house. But now I see you going off to Bermuda.
Right.
I didn't go off to Bermuda. I helped you get a house. So sometimes it's that kind of a thing. And you have to have, sometimes parents have expectations, oddly enough, of how their children should behave. Shocking. And that includes with money. So you do want to have those conversations, and mom, dad, thank you for this gift, but what involvement do you think that this buys you into my life? Maybe it is a straight out gift. We're not talking about repayment issues or anything, because that's a whole can of worms. If Lance gets wind of it, it's not a gift, it's a loan, and he can't do a loan. You know what I mean?
Yeah.
So it's truly a gift, but are there expectations involved?
Right. Absolutely. Please, for anyone listening, have that conversation and define the parameters behind what any kind of money that is being gifted to you or given to you, and what is the expectations going back.
Mm-hmm.
All right, we're at 40-some minutes, so I'm going to kind of get popping here. Another thing is this one, the option for the home seller to contribute up to 6% of the closing costs. This is huge.
Can you make it big? Oh, no, I meant like do the slide. There it is. Thanks.
So you could option for 6% of the sales price. So that's an FHA loan. And these are just 50,000 foot. So here's the next type, USDA. These are home loans guaranteed by the United States Department of Agriculture to provide affordable financing options for properties located in designated small towns, suburbs, and exurbs. Those are there's a lot of that around here. You'd be surprised how much falls into this. Jennifer, I can help you look that up and find out if you're eligible for that. But what does it offer? It offers 100% financing. There's a small guarantee fee, and you can actually finance up to 102% of the appraised value for help with your fees. Very low FICO score requirement, same thing, goes down to 580. Low interest rates, low closing costs, and you're allowed to use the gift funds for closing costs. It's a fixed rate mortgage. The properties have to be in a USDA designated rural area. There are maximums for the loan amounts based on the area that you live in. And there's income requirements, which could only be 115% of the median income, which in the rural counties can become an issue.
Yep. And it is household income. So sometimes we have somebody going, oh, my fiance is probably moving in with me. Well, you know what? I probably wouldn't be saying anything about it because they probably could change their mind tomorrow. And you might not be engaged, or they might be doing something else.
And
but
whether they're on the loan or not, that's going to be
and if now that you have to have their income, and it might put you above the cap. The other thing too is, correct me if I'm wrong, Lance, children over 18, their income counts too, right?
Yes, if they're working, it would count.
Yep.
I'm going to back up a page. Conventional. We never talked about conventional.
Yeah.
So conventional mortgage refers to any loan that's not insured or guaranteed by the federal government. It's actually owned by private entities like Fannie or Freddie or different investors. But wait, Mark, who owns Fannie and Freddie? the U.S. government. So conventional mortgages typically have a slightly higher down payment than government loans, but they will normally provide home buyers with more flexibility and fewer restrictions. Here's some highlights. Lower interest rate options for borrowers with good credit. I would argue that at this place in time in history, the last 18 months, actually FHA rates are a little bit better. The reason being is that the FHA loans may have a longer time on the books than conventional. When interest rates go down, the conventional stuff's going to fly off the shelf. And because of that, because conventional mortgages are traded on the free market, on the stock market, they're expected to make money. And they're not going to be bought and sold for very much money right now because everyone knows they're going to be paid off in full. Does that make sense to anyone?
Yep.
They have a performance issue, and that is that when interest rates go down, these will all be immediately refied. So the companies are like, well, how are we going to make money in originating a loan? They make it in the interest rate. So it's a little higher right now. A lot of people will argue with me. It'd be interesting to see that in the comments. Flexible mortgage insurance options. What I mean by that, conventionalism is you have to put 20% down to avoid mortgage insurance. Not the case. You can do a 95% loan. Depending on your credit, the type of property, different factors, you can either buy out your mortgage insurance or the lender can help you buy it out. There's many different ways around it. Very fewer penalties and fees associated with a conventional loan, flexible loan terms, and you have adjusted rate, fixed rate, and jumbo mortgage options.
And usually different appraising guidelines. Although, because we like to be unique, this year Lance and I had one that had some subject to on the appraisal. On a conventional, that's the second time I've had that happen. I mean, there's ways to deal with it, but everybody thinks, oh, this house has to go cash or conventional because it doesn't have floor covering in this room, or
right. It's either
whatever.
It's pass or no. No, there's other ways around it.
Yep.
And that's what I said about Jennifer earlier. She plays in the country, and not a dig on her, but there's some rural properties that are a little bit more challenging than.
Yeah, the challenging properties are usually urban and rural because of HOA guidelines in suburbia.
Keeping it up, exactly. Let's go on to our favorite, and then we'll cut it for the week. I think we're getting pretty hot. VA. I'm a proud veteran. Jennifer comes from a centuries-old line of veterans. One of her children is in the Air Force right now. She's a daughter of the American Revolution. Am I correct?
Yep. 9 generations in my family have served.
These are home loans that are backed by the Department of Veterans Affairs, and they provide affordable home financing options for eligible service members, veterans, and surviving spouses. Key to know, surviving spouses.
Yeah, that's a good one to know.
Product highlights is there's no prepayment. You can pay it off at any time. There's no mortgage insurance whatsoever. It's 100% financing. Don't pass go, 100% financing. Fixed rate mortgages, and the VA allows any finance fees to be rolled into the loan. There's a lot of variety of eligible properties, including townhomes and VA approved condos. And in order to qualify, you have to have a COE, which is a certificate of eligibility. And your loan officer or the veteran or the realtor will know how to get that. Hands down, the best loan.
DD214, is that what we're talking about?
Yep. There's a different one for Guard. I can't think of it. I think Jennifer will also agree with me. This is a very misunderstood loan program.
You want to see me get hot.
I'm going to cut you off. I'm going to go to the next thing. So we talked about a lot of these, and we can actually have breakdown days on all these. We can have VA day, FHA day.
Yeah.
Talk about fun things. But just if these aren't your average situation, it's not a problem. We have what are called non-QM. That means non-qualified mortgage options. We can do a bank statement loan. Mark, you'll like this. We can look at people's bank statements for the last 2 years. ITIN, that may not be in the works right now. We've been some changes with that the last couple of months. That's green card holders, I believe. Debt, we have what's called a debt service and credit ratio loan. We talked about that in a former podcast. That's where people can use the earning potential of an investment property they want to buy to qualify for the loan. And that's the only thing it's based on. It doesn't look at the borrower's credit. It doesn't look at the borrower's income, nothing. It only looks at what that property is capable of earning, and they'll make a loan based on that. And if they don't pay it, then guess what? They got a great performing property. We can look at derogatory credit events and help with that. We can look at asset depletion models. Mark, you want to explain what that is real quick?
Say that one more time.
An asset depletion model.
I don't.
I'll take care of it. The asset depletion model is where maybe you have someone who has $1 million in a fixed account. It's not qualified. They totally control it and self-directed. We can take that amount and divide it by X amount of months, and that will determine what their monthly mortgage payment could be. So if someone was of retirement age and they had $1 million in that, and they were going to go, I'm doing this calculation right now, they want to do a 10-year draw on that, that'd be 120 months to get count $8,300 a month of income using the asset depletion method. There's interest only options out there, excessive finance properties, don't know what that means, and high debt to income. Actually, Jennifer, a couple of loans you and I have worked on, we've gotten things approved up to 56% DTI. So those, and here's the quiz for the day, guys. Those were allowed to be approved because of what? Those high debt to income
Reserves,
That's one of those things that this falls under.
credit score,
Yeah, that's another one. Those are considered what? Something
high
factors.
risk.
Compensating factors.
Yeah, compensating factor. Yeah. And I'll tell you, interest only, that's what saved my family after my divorce. We had an interest only loan on the home that my parents had been in. They moved to a different one, and I knew the balloon was coming in 5 years, but interest rates, I was so fortunate. They dropped during that period. And so, I was well under $1,000 on my interest only payment when I first was out reestablishing myself. And, surprise, realtors don't make a lot of money the first few years, especially. And so I was lucky to be able to start kicking in the real estate business and in time to refi that. But had I not had an interest only note, I don't know where I could have had, 2,800 square foot home with 3 baths that would have allowed me 2 big dogs. I couldn't have rented that very easily. Not for under $1,000 in Williamson County.
I personally was in a unique situation during that 2008 to 2013.
Mm-hmm.
I had an interest only loan, and it was prime -1, and there was no floor.
Yeah. Mine didn't have a floor either. But so mine could drop however much, but when they started reassessing it, it could only raise 0.25%.
Yeah,
So I knew my drop date to get it refinanced, and I knew the max I'd have to pay each year if it rose.
Mark, I think my mortgage payment per month, I'm looking it up right now, was $70.
70.
Yeah,
Mine went down to $695.
$70 on a $330,000 loan in
Yeah.
Franklin in 2008, and we
Yeah.
saved. Guys, you'll laugh at this, and actually, I'll tell you this outside the call. I'll tell you this
Yeah,
outside.
but
the call.
that saved you because you were in the lending industry too.
Mhm.
When the bottom dropped out.
Yep, and I saved it. I'll tell you about that offline. But guys, we hope you had a great call. Put the comments below. We're right at 53 minutes. It's one of the best.
Oh wait,
yet.
we have next week. We have Shauna Hulse
Special
coming.
speaker.
She's with Foundation Title. She's going to answer our title questions and yours if you send us messages about that. And then also we are finalizing, hoping to do the April 29th buyers orientation, buyer seminar, whatever we're going to call it. Not necessarily just for first time, but in Spring Hill is where we're hoping to have it on the 29th at, I think we said 6:30, location TBD.
Outstanding. We'll have that. Hopefully we have it up when we post this. All
Yep.
right. Everybody have a great week.
See you. Stay safe.